Very good morning everyone. Can you please let me know, is the audio video clear to you all? Anyone? Please let me know. Audio video clear? All right, Sakshi, clear? Good morning everyone. Welcome back in this series of our RBI Annual Report. Yesterday the editorial and the report class could not happen because I was not well. But no worries, we will cover everything, okay? And today we are having the fourth lecture of the part 1, which is your prospects and review of Indian economy, right? So let's get started. In the last class, we have discussed till the financial markets, if I am correct, right? So we have done the financial market section in the last class. We have discussed the stability, that the bond market is in stability, the equity or shares market are very exuberant in case of India, right? And the GSEC yields we have discussed that have been moderated. Why they have been moderated? Because of higher prices. As you know that in the bond market, the price and the yield of the bond has an inverse relationship, right? So we all know that given these facts, we have discussed all the situations of our financial markets. Today we will be taking up from Indian rupee stability. What is the status of Indian rupee stability or its strength in our domestic economy and in international market? Let's see. Indian rupee stability. I hope you all have been revising the previous classes. Yes? Yes or no? Right? I hope so. So that it does not feels like a burden on you. Rather, when you keep on revising regularly, whether in small patches, okay, but it would add to your preparation, right? So you should keep on revising on daily basis because they have facts. These reports have facts and concepts. Although I am explaining all the concepts to you, but still revising only will help you, right? So that would keep you on track with the wholesome preparation, static as well as current, for your upcoming RBI Grade B examination, right? So keep on revising. Indian rupee stability, if we talk about, so Indian rupee basically displayed stability on the back of improving external sector and macroeconomic fundamentals. So if we talk about Indian rupee situation, Indian rupee has witnessed stability, which is to say, what do we mean by stability? That there is not much fluctuation, not so much appreciation, neither so much appreciation of rupee nor so much depreciation of rupee. Are you getting my point? So it is stable. It is stable. Okay. Now, why is it stable? It is stable due to strong external sector, okay, improving external sector. As you all know, we have discussed that our current account deficit is improving, right? So, current account deficit of India is reducing given more exports, right? So, we are improving on our exports. That's why we are able to earn more foreign currency, and that's how our domestic currency is stabilizing. It is neither appreciating too much nor depreciating too much. Clear? So, strong external sector is one of the reasons why your Indian rupee is stable. Then macroeconomic fundamentals. Economy as a whole is also performing well, as you all know, right? Economy as a whole is also performing well. That's why your rupee is also strong, including a significant moderation in the CAD, current account deficit. So we all know that significantly current account deficit has reduced or is reducing. It has been moderating in case of India, right? What is current account deficit? We have discussed current account deficit is basically so I have told you that the BOP, when we talk about BOP or balance of payment, it has broadly two categories, right? Current account and the capital account. In current account, we have exchange of goods and services, trade of goods and services, invisibles and goods, right? In the capital account, we have investments, borrowings, external commercial borrowings, all these kinds of things which lead to change in ownership of assets. So they all fall under the category of capital account BOP. But here we are talking about current account BOP. So current account is basically your trade balance, okay, export minus import. And export and import here includes both goods as well as services, remember, okay. So when we are saying that current account deficit is there, it means your import of goods and services are more than your exports, isn't it? What is deficit? When your import are more than your exports. But this situation is improving. CAD or current account deficit in India is moderating, which is to say exports are rising, okay. So this difference is getting shrinked. Is this clear? So exports are rising of goods and services. Exports of goods and services are improving in case of India. Clear? Okay. Now, so this is one of the reasons. I have told you CAD in detail in earlier classes as well. And resurgent capital inflows, as you all know that resurgent capital inflows. India has been attracting foreign investments as well, foreign capital as well. Very good morning everyone. India has been attracting foreign capital, so we have good inflows. Good inflows gives us currency, right? So we have foreign currency. On part of improving CAD, current account deficit, first thing. Second, capital inflows, we are attracting more foreign investments in all the forms, right? This is the thing that offset the persistent headwinds from volatile global financial markets. So all these performances on part of India are resulting into Indian rupee being stable, and stable does not mean it has not changed, but not very fluctuative, not very volatile as compared to the global scenario, because at the global level situations are very volatile. Economies are performing very in a fluctuating manner, okay. So global volatile scenario given, our economy is rather protected due to all these things, improving CAD, good amount of capital inflows, all these things, right? So this is the report says that offset persistent headwinds from volatile global financial markets. So this impact of volatile global financial markets have been offset by this good performance, right? Good performance on part of CAD and on part of capital inflows. Strong US dollar and persisting geopolitical tensions. So since Indian rupee gets affected by all these phenomena, right? You all know that US dollar is a strong currency, right? Globally accepted currency for trade. So given these facts that there are geopolitical tensions going on, US dollar is still strong, we have global financial volatility, still Indian rupee is managing to perform well. Why? Remember these reasons. Remember, okay? This is very important. Moderation in current account deficit of India, that is moderation in trade deficit, basically trade of goods as well as services. So we are improving upon exports. Clear? Then resurgent capital inflows. All right, this is the thing. Then we talk about depreciation. If we talk about depreciation, INR depreciated by just 1.4%, the report says. Okay, so this report says that INR has depreciated by just 1.4%. Why am I saying just? Because it is lower as compared to the previous data, which is down from 7.8 in the previous year. So in the previous year, if you are able to notice here, in previous year rupee depreciated by 7.8%. 7.8%, but now it has depreciated only by 1.4%. So this shows stability. This shows stability, isn't it? Yes or no? Right? Although depreciation is favorable for exports, but so much depreciation is also not good. Okay? Very much depreciation or very much appreciation of rupee makes your currency weak in international market. It leads to losing of investors' sentiments or confidence into your market. Are you getting my point? So although depreciation is beneficial for exports, but it has to be somewhat stable. Are you getting my point? It has to be somewhat stable. So this is why we say, so if you have been asked in the examination, say at any stage, if they ask you that what has been the situation of Indian rupee, so you should say it has been stable. Okay. Now, among the best performing major EME currencies, so one more achievement, that among the best performing emerging market economies. EME means emerging market economies. Those economies which are emerging very fastly to be developed nation. They are developing very fast. Okay. Among them, this is a good achievement because our currency has managed to avoid these fluctuations and to be on a stable front. Clear? Now, one thing which I want to tell you, or I want you to brainstorm about, is depreciation and appreciation. Do you all know what is currency depreciation and appreciation means, right? So, I hope you all know that, but just let me explain once. So, if I say, you'll let me know, okay? I am giving you two situations. You tell me which one is appreciation and which one is depreciation, right? So, if I say that earlier for $1, say $1, okay, $1 you had to give 60 rupees. Now for $1 you have to give, say 70 rupees. Okay, 70 rupees. So this situation is appreciation or depreciation? Appreciation or depreciation? This situation. This is depreciation, right? You have to give more rupee to buy one foreign currency, one unit of currency. So basically, what is exchange rate? Exchange rate is how much units of your currency, domestic currency, do you need to pay in order to buy one foreign currency, one unit of foreign currency, right? So this is depreciation, and this is appreciation. Say $1 earlier was 70 rupees, okay, but now $1 is now 60 rupees. So this is appreciation and this is depreciation, isn't it? This is appreciation, agree, right? You have to give less of rupees to buy one unit of your foreign currency. Say for in this example, this is US dollar, okay, appreciation. Now tell me, which situation is better? You should understand why do we talk about depreciation and appreciation. Why are we concerned about these things? What impact does it have on our economy? So, is it better for importers or exporters? Tell me, depreciation is better for whom? Depreciating domestic currency is beneficial for exporters or importers? Anyone? Is it beneficial for exporters or importers? Depreciation, I am asking you. Exporter, very good. So you all know that. Now why is it beneficial for exporters? So always remember depreciation of your currency, domestic currency, when you have to give more of rupees to buy a foreign currency, is good for your exports. Why am I saying that? I'll explain it to you. And appreciation is good for importers. Okay, appreciation is good for importers. Now let's understand why. See, when we say that our rupee is depreciating, say in comparison to US dollar, okay, what does it mean? It means exports are what? Exports are foreign demand of your domestically produced goods and services, isn't it? Export is what? Foreign demand of domestically produced goods and services. So if $1 was able to buy a good or service worth of say 60 rupees earlier, okay, now $1 is able to buy goods or services worth of rupees 70, isn't their demand will increase, because now $1 is able to purchase more worth of more rupee worth of goods and services from India? Tell me, yes or no? Did you get this? So now $1 is able to buy more rupee worth of goods and services from India. So if you are able to buy more with the same price, your demand will increase, isn't it? So when your demand will increase, that means foreign demand for Indian goods will increase. It means what? Exports will increase. So that would be beneficial for exporters. Exporters will be incentivized to export more, isn't it? So this is the situation. This is how depreciation helps boost exports from a country, okay? And why is it beneficial for importers? Because when you import, you have to give the currency, right? When you import, you have to pay. So you have to pay less when it is appreciating. You have to pay less when it is appreciating. So your import bill gets eased, isn't it? So have you understood why appreciation is better for importers and depreciation is better for exporters, right? I hope you have understood. So given this situation, I just want you to remember these two words, okay? First is depreciation. We all know, better for exports. Why? More foreign demand, since more foreign currency is able to buy more rupee worth of goods and services given the same unit of currency, right? Earlier $1 was purchasing 60 rupees of goods and services, worth goods and services. Now $1 is able to buy 70 rupees worth of goods and services, okay? So it is better if you are able to buy more by paying the same amount, okay? So that's how exports boost up. But this is one thing. There is a word called devaluation. I want you to understand this. Devaluation. You should remember devaluation. This is depreciation, but then there is another word called as devaluation. I want you to remember the difference between depreciation and devaluation. What is the difference? Depreciation is, since you all know that like any other market as of now, we have free market economies, right? We have left everything in the hands of market forces of demand and supply. They only determine the quantity, the price of everything, the exchange rates. So in foreign exchange market as well, we have a free market mechanism, right? As compared to the earlier systems. So now we have freely deciding market forces. So demand and supply only decide your foreign exchange rate as well. So when due to automatic market forces of demand and supply, your currency depreciates. It is called depreciation. But when depreciation is done deliberately by your government or say by RBI, managed floating and all these kind of activities, to boost exports, to support your exporters, that is known as devaluation. Remember, that is known as devaluation. Yes, that is known as devaluation. So remember, devaluation is deliberate depreciation by your authority. And authority is, say, Government of India says and the RBI does, because RBI only has the foreign currency reserves, right? So buying and selling of foreign currency will affect your value of your domestic currency. This is also known as managed floating. When RBI, when the central bank tries to intervene in the foreign exchange market so as to affect the value of your domestic currency, okay, to make it stronger or weaker, say depreciate it or appreciate it by selling and buying of foreign currencies in the market, this activity by the central bank or RBI is known as managed floating. You should remember, managed floating. So when depreciation is done deliberately by the government or the central bank, it is known as devaluation. Clear? I hope you would remember the difference. So depreciation is automatic depreciation by the market forces of demand and supply. Devaluation is deliberate depreciation by the government or the central bank. Clear? Remember these things. Now, so when we say that INR depreciated, so whenever your rupee depreciates, remember exports will rise or it will help exporters. Clear? So you should understand that since rupee has depreciated but not very hugely, right? So exports must have improved, and that's how we know that CAD, current account deficit, total exports minus total imports, has also improved. Our exports are improving. You can relate all these things like this, isn't it? So this is your situation of Indian rupee in the given in the report. You should remember all these things, right? I have explained the concepts as well. Now you should revise these things. Then you have the equity market. So if we talk about the share market or the equity market, what is the performance of India's share market? So we say that we have gains in the share market or equity market, okay? Solid gains on robust corporate earnings and strong GDP growth. So if they ask you what has been the performance of India's equity market, then share market or equity market is performing well. Rather, we have had solid gains. And if you are following our editorial analysis on daily basis, you must know that we have discussed Indian stock market, share market or equity market is performing very well. It has been exuberant. Earlier mentioned in the report itself, right? It has been exuberant. We have domestic investors investing more in the market, as well as we have foreign inflows coming in, right? So we have a good equity market. Now why? Corporate earnings are improving. Companies are able to make out profits. They are able to make out their markets, and that's how, if you are able to recall, in one of the editorials we have discussed that India has become 5th largest economy in the world to have 5th largest market capitalization economy. We have discussed in our one of the editorial classes as well, right? That India now has, say, we have crossed $4 trillion mark of market capitalization and have become 5th country to do that, right? So it is a huge achievement. That shows that our stock market are very exuberant. So you can relate this news and that analysis as well. Are you getting this? Okay, so this is strong, and of course our GDP growth is there. So when your GDP grows, investors have confidence in your economy. They know that your economy is growing. They will be able to reap benefits out of it, right, if they invest. So they suspect, or they can see positive returns from your market, right? So this is the case. Then intermittent corrections due to geopolitical concerns and uncertain monetary policies. Gradually geopolitical concerns are also getting corrected. Okay, they are not very uncertain as they were earlier in the previous year, right? And uncertain monetary policies, since you all know that at the global level inflation has been above the desirable limits, right? So but now almost all the economies have followed a tight monetary policy stance. As you all know that Indian Monetary Policy Committee has also accommodated, or has also adopted, the withdrawal of accommodation policy. If you remember from the last class, withdrawal of accommodation means not adopting accommodative policy. Not adopting accommodative policy means tightening of monetary policy. You want to reduce the money supply in the market. Why do you want to reduce the money supply? Because you want to contain the inflation. So you all know we have discussed all these things, right, in previous classes as well. So this is the thing. Now this is the great achievement which you should remember by heart. The number also you should remember, that India has crossed $4 trillion mark in market capitalization in half two. H2 here basically H2 is second half of the financial year, okay, second half of say 2023-2024, and has become the 5th largest economy to do so. So H2 wherever written, H2 means second half, okay. So you have first half, first 6 months, and then the second half, the later 6 months, right? This is the news which we have covered in our editorial classes also. Now what is market capitalization, if you remember? Can anyone let me know, please? Can anyone tell me what is market capitalization? When we say that we have huge market capitalization, that means what? How do we calculate market capitalization of a company or a corporation of any financial entity? Anyone please? I would appreciate if you tell me the exact formula. What is the formula of market capitalization? How do we calculate it? Total outstanding share multiplied. Yes, very good. So how do we do that? We take into account what are the total outstanding shares, okay? The shares held by the public which are not yet realized, okay, by the company, okay. So still held by the public, all right, apart from the promoters I am talking about, right. So still held by the public. All the shares out there in the market multiplied by current value of each share, because price of share varies, right. So this gives you market capitalization. It shows how much you are able to capture the market, isn't it? So total outstanding shares multiplied by current value of one share, right, of that company. This gives you total market cap, M cap. And if your M cap is rising, your value, your market is expanding. That is a good sign. So India has become 5th largest economy to have crossed 4 trillion US dollars of market capitalization. That shows that our share market are expanding. We have exuberant equity market. We have an exuberant share market or stock market, right? So this is it about equity market. You should remember these things, okay? Then if we talk about monetary policy and banking, if we talk about the monetary policy and banking, what has been the situation regarding monetary policy and banking? So first is repo rate transmission. If you remember, in the last class only of RBI report, I explained to you what is repo rate, why is it called repurchase option, what is the mechanism of taking of loan by the commercial bank through the RBI via repo, right? You remember that? Repo is repurchase option. So basically commercial bank has to sell government securities to RBI or place them as security, then they will buy back it again from the RBI. This is how the loan is disbursed, isn't it? Right? So repo, short term and against government securities. I also told you the mechanism, entire mechanism in the previous class. So I hope you all remember that what is repo. Now monetary policy and banking, if we talk about, first is repo rate transmission, okay? So continued into lending and deposit rates. Report says that the transmission of repo rate has continued. That means repo rate decisions, as you all know, kept high at 6.550, right, or 6.5, has been transferred or transmitted to the banking system. So you would expect that the interest rates in the banking system at which the public is offered loan has also increased, isn't it? That is known as monetary transmission as well. Monetary transmission or transmission of your monetary policy. Are you getting my point? Right? So you understand that repo transmission has been effective in India. It has been transmitting. So that's how we are able to contain the inflation. Otherwise it would have risen a lot. Clear? First thing. Second, credit growth persistently outpacing deposit growth. You all know how credit creation is done by the bank. How a commercial bank does credit creation. You deposit your money into the bank gives you interest, okay, but that would be less than what bank charges you when you take loan from the bank. This is the difference and the earning by the bank, isn't it? You place your deposits with the bank, those deposits, the fund placed under those deposits are used to advance loan, right? So bank work on this assumption that all the depositors are not going to come to the bank on the same time, on the same day to withdraw the money. Otherwise there would be a run on bank. That situation would be a run on bank, right? So they assume everyone is not going to come back at the same time to withdraw their money. That's why they lend your money, your deposited money to the borrowers, right? This is how they create credit creation process as we call. So credit growth is there. Credit has increased as compared to deposits. Deposit growth in comparison to deposit growth, credit growth is higher. That shows that people are borrowing in the economy. And borrowing is there, that means investment activities are there going on. Yes or no? And when investment activities are going on, it shows economic performance is good. You are producing something. You are investing your money. Household savings are channelized into productive purposes. Isn't it? Agree or not? Understood? So this is the thing. Alright, have you understood till this point? Any doubts so far? No doubts? Alright, so next if we talk about external benchmark loans. Now this is very peculiar and you need to remember this trend as well. What is this? What is this? This is external benchmark loans. External benchmark loans. So report says that the external benchmark loans share of external benchmark loans have increased, while marginal cost of funds based lending rate loans have fallen down. What is this? What does it reflect? You need to understand the big picture. Okay, first of all, remember that when we say interest rates, so there are interest rates which are offered to us, to the common public, okay, common man, to the public, for say borrowing or for taking loan from a commercial bank, okay, and there is another interest rate which is decided by the RBI for the purpose of banks transaction with them. Do you get that, right? What is external benchmark rate? External benchmark rate is that rate which is not decided or affected by the commercial banks or the banking system. It is decided by your central bank. It does not get affected by the operation cost, tenor premium, all these criteria of the banks given for that matter. Are you able to understand this? So broadly, if I tell you, there have been 4 rates for this purpose. Rates which affect your interest rates at which we get loan. Okay, so there have been broadly 4 such rates for this purpose. The prime lending rate, which was earlier at the very initial level, right? Prime lending rate. We had prime lending rate, on the basis of which the commercial banks decided that this is the interest rate which they will charge to the customers. Clear? Then it was replaced by BRS, base rate system. You should remember, base rate system. It was replaced by base rate system. Okay, base rate system. But then base rate system also did not work very properly. So then we had marginal cost of funds based lending rate, and then another we had repo rate based lending rate, RRLR. So now these two are existing, they are not existing. Remember. Are you able to understand this? Now these two are existing. So you should remember that RRLR has not replaced MCLR. These two are coexisting. But these two have been replaced by MCLR and RRLR. Got this point? Right? So presently the interest rates on the basis of which we get loan from the RBI, the customer, the public get loan from the RBI are these two rates. MCLR, which is your marginal cost of funds based lending rate. MCLR, marginal cost of funds based lending rate, and another one is RRLR, which is your repo rate based lending rate. So have you understood till this point that earlier we had prime lending rate, then we had base rate system, but then both did not work properly. They have a lot of loopholes. So then these two were replaced by MCLR and RRLR. Clear? So now we have MCLR and RRLR. Okay, first MCLR. MCLR is what? Marginal cost of funds. Just try to understand these are very important concepts. I'll explain you once, and then whenever these concepts get repeated over time in the reports discussion, you should understand that this was the explanation, right? Marginal cost of funds, marginal cost of funds based lending rate, What is this? MCLR. As the name suggests, marginal cost of funds based lending rate. So it is a lending rate which is based on marginal cost of funds. Okay, first thing which you should remember about MCLR, it is the minimum rate below which banks are not allowed to lend. So it will be your floor rate. Okay, bank cannot give loan to anyone below MCLR. Below MCLR. Okay. So it is minimum lending rate, first of all. Minimum lending rate, below which giving loans or extending loans is not allowed. Clear? First thing. Now, MCLR, as the name suggests, marginal. I have told you number of times in our classes as well that wherever in economics, I'll come to your question. So I was saying marginal, okay. Wherever you read this word marginal means an additional. Marginal means what? An additional. An additional. Okay. So wherever marginal is written, you should understand it is an additional unit. So it is given marginal cost of funds. That means what is the cost which is incurred by the bank to arrange an additional fund to the borrower, say to arrange an additional loan to an extra borrower. Are you able to understand this? So what cost does the bank has to incur in order to give an extra loan for that matter, right? So it is additional cost. So this marginal cost of funds, now you understand what is marginal cost of fund? Additional cost of funds. Additional cost of arranging an additional fund for the borrower. Clear? So these costs are taken into consideration to decide the interest rate. So it is internal reference rate. Why do we call it as a reference rate? Because this is a reference rate decided by the RBI. RBI decides it, but then this reference is taken by the bank to decide the rate at which they will give you loan. So that rate will be higher than the MCLR or equal. It cannot be lower than the MCLR. Do you understand that? Yes or no? So banks will decide their lending rate based on the MCLR. It can be equal to MCLR, it can be above, but it cannot be lower than the MCLR. Banks will decide. Why? So first RBI gives you the reference rate as MCLR, but then banks will decide based on their cost. They will see that this extra fund or extra loan, what is the tenor premium for that? Tenor premium means duration of the loan. Okay. So higher the duration, more the interest rate, because greater is the risk. Do you understand? So then cost of funds, what is the cost the bank has to incur to give the loan? Okay. The operational cost which the bank has to incur, all these costs basically are taken into consideration then, and then the commercial bank decides the interest rate based on the MCLR. So this is your internal benchmark rate. That's why we call it as internal. Why internal? Although decided by RBI, given by RBI as a reference to you, but you can have changes to it depending upon your cost which you have to incur. Are you getting my point? But then there is another. So have you understood the MCLR? Everyone, let me know yes or no very quickly. I hope you have understood, right? MCLR. Then another one is our RRLR, repo rate based lending rate. Now this is called as external. Why external? Because banks do not have any say in deciding of this interest rate. As the name suggests, it is RRLR, repo rate based lending rate. So it will be directly linked to what is the repo rate in your economy. What is the ongoing repo rate? Clear? Okay. So it is linked to your repo. Say presently repo is 6.5. So that would decide the lending rate. But MCLR a bank can have changes based on their cost. That's why this one is internal and this one is external. Because banks do not change the rate RRLR, they cannot impact the RRLR. Okay, it is decided by the RBI and it is directly linked to your repo. So this helps in monetary transmission, if you can see, isn't it? RRLR, repo rate based lending rate. It helps in monetary transmission. Because directly lending rate is related to your repo rate. Whatever the decision of monetary policy committee is there regarding repo, that would be transferred to the public. Isn't it? right? So these are the two. So when we say external benchmark rate, we mean repo rate based, and when we say internal benchmark rate, then we mean MCLR, marginal cost of funds based lending rate. I hope this difference is now clear to you all. Can you please let me know? Okay. Now your question was that it can also be indication of reduced savings rates in the country. Yes, we can say that, Mayur. Okay, we can say that because deposits are reducing, but you cannot generalize this statement. Why? Because this fall in deposit rate can also be due to divergence or say change in the channeling of household saving. So it might be the case that household saving have not fallen down, rather they have changed their course of time. So if you remember, in our editorial classes we have discussed that Indian middle class is particularly investing heavily in the SIPs. So that might be the case that those savings are going into SIPs because they are considering them as more attractive, right? So this can also be the case. Okay. All right. Anyone? Have you understood the difference between MCLR and RRLR? Okay, I'm assuming you have understood, since I have not got any responses from you. Okay, so now when we come back to this news that external benchmark loans have increased. External benchmark loans have increased. So now you understand that loans related to RRLR, as I told you, external benchmark rate is repo rate based lending rate. So loans related to your repo rate have increased, and that's why you can say that repo rate transmission is happening. You can link all these news together. When loans related to repo rate based lending rate are increasing, that means directly the decision of repo rate is getting transmitted to public. What is the repo rate? That would be the interest rate, isn't it? So this is also helping in monetary transmission, and marginal cost of funds based lending rate loans fell. So they have fallen down. It shows that loans are more linked to repo. Now you know what is MCLR. Okay, I have explained to you, which is a good sign on from point of view of monetary transmission. So we will be able to contain inflation because given this trend. Why? Inflation will be contained not only by the RBI and MPC sitting there and deciding repo to be at 6.5 or might be higher than that. It will only be contained when that decision is transmitted to the economy, to the public, via the interest rates which the bank charge to us. Are you getting my point? So this is the thing. Remember, okay? So external benchmark, RRLR, repo rate based have increased, and MCLR based loans have fallen down. So if they ask you, is it a better situation? You can say yes. From the point of view of monetary transmission, we can say this is good. Okay. Now, currency circulation. So if we talk about currency in circulation, expansion moderated. So currency circulation's expansion has moderated. Money supply, which is to say, has moderated. Why? These steps, as you know, withdrawal of accommodation taken by RBI. So RBI is continuously aiming to reduce money supply through monetary policy. That's why, you know, repo rate has been kept high, 6.5%, right? So expansion moderated, and you know that external benchmark loans, the repo rate based loans have increased. So the interest rates are also linked to repo rate, which is higher. So they are also higher. That's why money supply has moderated as compared to the previous levels. So we are able to contain the inflation. Okay. Deposit growth accelerated post 2000 banknote withdrawal. So now here is another answer to your question which I just received, that is it reflective of lesser household saving? No. What we can say is, we cannot generalize that no or yes, rather we should find a way in between, right? As I told you that the method of investing those savings can change, and here the report says that deposit growth has accelerated. People are depositing more. People are depositing more. Okay, now you should understand one more thing here, that when repo rate increases, it is the key policy rate, other interest rates also increase. So interest rates on the loan which we take from the banks increases, but the interest which they provide on deposit also increases. So you should remember, if you get more interest on depositing the money, that would give you incentive to deposit more money. And when you deposit more money with the banking system, the task of RBI is simplified. Money in circulation gets reduced. Isn't it? Agree or not? Yes or no? Let me know. So this is the entire thing related to monetary policy and banking. Okay. I hope you have understood everything. So as you know that 2000 denomination, rupee 2000 note has been, okay, what is this? It has been withdrawn because as you know counterfeit currency was there. So now this is no longer accepted as of now as legal tender, but post this situation, the withdrawals have reduced and deposits have increased. So you should remember this. Is it clear to you all? Okay, this is the thing. Now fiscal consolidation in 2023-2024. So we have talked about monetary policy, we have talked about banking. Now we will be talking about fiscal consolidation. I have already told you what is fiscal consolidation, right? So we have discussed it n number of times by now. So by now you all know what is fiscal consolidation, right? You all know what is fiscal consolidation. What is fiscal consolidation? When the government is continuously trying to improve its performance by cutting on the unnecessary expenditure, not the necessary ones, and improving upon its revenue sources, trying to make or generate more sources for revenue so that fiscal deficit can get reduced. Okay, so continuously trying to reduce fiscal deficit, simultaneously trying to achieve higher economic growth. This is fiscal consolidation. Is it the same PDF provided in the course? Yes, PDF is same. Okay, the one which you have been provided with, it is the same thing. All right. So this is fiscal consolidation, more prudent fiscal policies on part of the government of India, trying to reduce the fiscal deficit at one point, simultaneously trying to achieve more higher economic growth. Okay. Now let's see central government first we talk about. So we will see fiscal consolidation for both central as well as your state governments. Firstly, central government, gross fiscal deficit declined to 5.9. So as we have discussed in our editorial analysis classes as well, that presently fiscal deficit is how much? 5.9% of GDP. 5.9% of GDP. So they have declined to 5.9% from earlier 6.4. It was much higher earlier, but rather it has declined now, which is a good sign because it reflects that government borrowings will get reduced. Do you understand that? And we have discussed what is fiscal deficit. What is fiscal deficit? Can you please let me know? Anyone? What is fiscal deficit? So fiscal deficit is your total expenditure minus total receipts. Okay, when do we have deficit? When our expenditures are more than our receipts, isn't it? Okay, so gross fiscal deficit will be your total expenditure are more than your total receipts. So total expenditure minus total receipts. Fiscal deficit is equals to total expenditure minus total receipts. Okay, when you have more expenditure than receipt, it is your deficit. Now excluding borrowings, you should always remember this formula. This is not complete yet. Excluding borrowings. So receipts which you get in form of borrowings are excluded. Do you understand that? Excluding borrowings. Do you understand that? Fiscal deficit means total expenditure minus total receipts apart from borrowings. Why? If we include borrowings in this formula, because government also gets funds from borrowing, isn't it? But that is not included in your total receipts. Why? Because fiscal deficit is nothing but the borrowing. So if you include borrowing again, that would lead to double calculation and exaggeration of the numbers. Are you able to get that? I don't know how many lectures will be there, okay, but it's just that we are trying to complete this report. This section, part 1, which is your prospect and review, is taking time because everything is written over here, everything. So whatever we have discussed, we will not repeat it later in the second part, okay. So there are a lot of things which have been repeated again and again, that would not happen. So I don't know how much time exactly will it be taking, but your focus should be on this thing, that we are trying to complete it in a wholesome manner. Static plus current getting prepared together, right? So I also don't know. It's just that I want you to understand everything which is there in the report, because it is one of the most important documents which you can have directly for your RBI Grade B examination. Are you understanding this, right? So see, I can increase my speed. I can just let you know that fiscal deficit has declined, revenue spending is this, tax revenue this. But if you do not understand the meaning of fiscal deficit, if its implication, if it is declining, is it good, is it bad, then there is no matter discussing the report. You can only remember the facts at your own, right? So this is the thing. Okay. So have you understood that in fiscal deficit, we do not count borrowings. It is total expenditure minus total receipts apart from borrowings. Why? Because tell me one thing, quick answers I want from you. If you are running into deficit, say you are living outside, your parents send you money, your expenditures are more than your receipts, what will you do? You will borrow. So say if you have a deficit of 1000 rupee, you will borrow 1000 rupee, yes or no, broadly. Okay, I am not saying that you will sell your assets or those things. Broadly, what is the behavior? Borrowing that much amount, isn't it? Quick answers, yes or no, right? So what government does is, government also does the same. Whatever is the deficit is the borrowing of the government. Whether the government borrows from your domestic market or it borrows from the foreign market or from any foreign institute for that matter. Are you able to understand this? That's why always remember, fiscal deficit formula excludes borrowing, because fiscal deficit is equal to borrowing. If you include that, it would lead to double counting. Okay, so fiscal deficit has reduced, which is a good sign, because as I have told you in the previous editorial classes also, that according to the FRBM Act of 2003-4, which is your Fiscal Responsibility and Budget Management Act, okay, FRBM, Fiscal Responsibility and Budget Management Act, it specifies how much should be these deficits on the part of central government and state government. So as per FRBM Act, presently the target which has been given is 3% of your GDP, that your fiscal deficit should be at 3% of your GDP. That would be ideal, okay. You cannot eliminate fiscal deficit. Government will always run into fiscal deficit, because government has to do public welfare, has to spend, whether it has revenue or not. Are you getting this point? Although in the later escape clause, which was inserted by amending the FRBM Act in 2018, according to that escape clause, there are certain situations like natural calamity, destruction of agricultural crops, war, all these unprecedented situations in which you can breach this target by 0.5%. So that comes out to be 3.5% effectively, right? That can be the limit according to the escape clause. Getting this point? But it is still higher, 5.9. But at least we are approaching the target, which is 3% of our GDP. Okay, why do we need to cap this? Why do we have to reduce fiscal deficit? Because if fiscal deficit is higher, you know that leads to crowding out effect, isn't it? What is crowding out effect? Now fiscal deficit is higher, government will borrow more. So if government borrows more from your market, the funds available for private borrowers, for investors, will be less. So investment activities will be less. Depositors' money, households' money will be sent for borrowing, for covering up the borrowings rather than being used in productive uses. Are you getting this point? So that can lead to very negative costs to your economy. That's why fiscal deficit has to be kept. Otherwise the savings, the entire household saving can get channelized into paying back of your loans, your borrowings, isn't it? So this is why we need to reduce the fiscal deficit, and that's why this is good that the government is able to reduce the fiscal deficit. Okay, I hope you have understood all these things. Let's move ahead. Then if we talk about revenue spending, growth contained at 2.5% while capital expenditure grew in double digits. So this is again good performance if we are coming closer to the target of 3% of GDP as prescribed by our FRBM Act. Now expenditure are also of two types on the budgetary part. Government has two types of expenditures, as you know, revenue expenditure and capital expenditure. Okay, revenue expenditure is which is not changing the status of asset and liability for the government. Okay, for example, the government employees, government has to pay salary to the government employees, right? That is a kind of revenue expenditure. You have to just, you are doing your expenditure on your part, but that is not creating any asset for you, rather nor is it reducing your any liabilities. Okay, so those kind of expenditures by government which are not changing the status quo regarding liability and assets of the government are your revenue expenditures, like payment of the government employees, all these things, right? Other one is capital expenditure. As you know, that capital expenditure is the expenditure in capital assets or capital goods which further create income, which further generates income. So it is very praiseworthy that revenue spending has been contained at 2.5 because it does not lead to any income generation, and capital expenditure grew in double digits. That is a good sign because capital expenditure is investments into assets that is going to pay back to your economy and to you in future, isn't it? So this is praiseworthy. Okay, for the fourth consecutive year, continuously for the fourth time we have seen increase in capex, okay, or capital expenditure by the government. This is good. Now, so you need to understand that all these things happening, are they good for the economy or they bad? Then only you will feel confident, you know, when you, I hope you all you are able to qualify the previous two phases and are able to face the interview, right? So then you will see, you will realize the benefit if you reap out of these classes, because they don't want you to remember that fiscal deficit is 5.9% of GDP presently. They know that all of you know this. What will make the difference is they want you to understand whether you understand this situation, the gravity of this situation, that if it is higher than the target, what impact will it have? If it has been able to come closer to the target, what benefit it could have? So they want you to be aware about the application of all these things. That's what we are trying to deliver to you, right? So we are in no hurry of completing the report. We are just aiming to make you understand what the entire thing is going on. Getting this point? Okay. Now, tax revenue. So if we talk about tax revenue, as you all know, you know, that revenue sources, if you divide the revenue sources of the government, broadly it can be classified into two categories. First is tax revenue, all the revenue or receipts which the government generates from the tax sources, direct, indirect, okay. And other one are non-tax revenues, say from fees, okay, say from grants, from donations, anything which is non-tax receipt, say your capital receipts, okay, revenue receipts, capital receipts, like selling out of an asset, doing privatization, doing disinvestment, doing divestment, right, selling out of some shares. So all these receipts will be your non-tax revenue receipts. Are you getting my point? So what about tax revenue? So here we are talking about tax revenue, revenue collected through taxes. Gross tax revenue at 11.7% of GDP, which is highest since 2008-9. That is a good sign. That is again a good sign. Why am I saying that? Since 2008-9 it has been the highest. Do you understand this? Okay, 11.7% of your GDP. It shows that tax is becoming more buoyant. There is a term here which you should know called as tax buoyancy. Tax buoyancy. How many of you have had science as the background? You must have, or even if you are not a science student, we all have studied buoyancy in physics, right? Maybe at 10th level. Yes or no? Buoyancy. So what is buoyancy? Buoyant force. What is buoyant force? That when you dip something into the water, this buoyant force pushes that up again, isn't it? Pushes that up again. So tax buoyancy is, if your GDP is rising, how much force is that exerting into your tax collection? Your tax administration, your tax rates, your tax collection are said to be efficient. If rise in your GDP is letting your tax collection rise upfront, yes. Okay. So do you understand that if GDP increases, your tax collection increases, that is a good situation. It means your tax administration is efficient. Otherwise, there are problems. So if with rise in GDP, we are able to collect more taxes, that is a good sign. More tax base is there, tax base is expanding. So people coming under the income tax slab, say, are expanding, right? People are complying more with the tax norms. Since tax norms are becoming easier to comply with day by day, given the initiatives taken by the income tax department and the central government. So all these things are there. So our revenue generation has increased. Then if we talk about the general government deficit moved lower in 23-24, even as general government capital outlay increased from 5%, okay, to 5.6. So here is a contrast given to you. What is the contrast? The report says that government deficit moved to lower, as you all know, to 5.9, given more capital outlay presented by the government in the budget. More capital outlay as compared to the previous time or previous year. This shows what? Contribution of taxes. So government has not cut down on its capital expenditure, which are necessary for economic growth. Despite increasing capital outlays and expenditures, government has managed to reduce the fiscal deficit. That shows your revenues have increased. And this is the thing. So everything is relatable. They are not lying there into isolation. They are working together. It's just that we need to understand, read them in isolation. That's why they are written separately. Right? So this is the thing. This is the performance of central government. You can say it is quite praiseworthy. Although we need corrections, we need to reduce more fiscal deficit, but they are on a right track, right? Then we should also quickly talk about the state government situation. State government. So if we talk about the state government's gross fiscal deficit has been budgeted at 3.1% of GDP, which is very much within the limit prescribed by the center or by the FRBM Act. So state governments are performing well on the fiscal deficit part. Okay, their fiscal deficit is 3.1% of GDP. Given that you can extend it to say 3.5% as per the escape clause, as I told you. 0.5 can be extended during natural calamity, climate change, agricultural crop destruction, war, disaster, all these situations. So effectively they are within the limits, isn't it? That is very praiseworthy. Then capital expenditure of state governments has also increased. So state governments have also managed to increase their capital expenditure by 19.4%. Now you can be asked that when center and states both are able to increase their capital outlays, still they are managing fiscal deficit within the they are able to reduce the fiscal deficit or manage the fiscal deficit. Why? Tax revenue is increasing. Tax revenue is increasing. As you all know, since GST has been launched, GST is contributing very significantly to the overall government tax revenue. Are you getting this point? Right? So tax is contributing to their receipts and they are able to do these expenditures. GST is one of the greatest contributions to the revenue generation for center as well as for the states. Have you understood this? Any doubts so far? So in next class we will be taking up the Reserve Bank and government securities from here. Okay. So we have completed till fiscal performances of central and state governments. I hope you are able to understand all these things. You are able to understand the report in detail, what is happening in the economy actually, right? And since we are also having editorial classes, you will be able to link more phenomena with each other, right? So that would be helpful for your examination. I am waiting if you have any doubts, otherwise I'll wind it up. No doubts? All right. I hope you have understood this. Thank you so much for staying focused in the class and have a great day. I'll see you in the next class, in editorial class. All right. Yes, yesterday editorial class didn't happen, but I'll see if there is any important editorial. I'll take it up today or in some other classes. So you will not miss upon anything. Just rest assured that we or I, on my part, in case of editorials, I'm trying to maintain this continuity. Nothing will be missed. Okay, we want to deliver everything timely to you. It's just that sometimes due to some reasons classes do not happen, but then I'll cover those newspapers. If there is anything which is important, I'll take up in the next class. Okay, you rest assured about it. How will this data be used in descriptive? Which topics? So which topics are important? Everything is important because everything is under your syllabus, right? But how you use the data, that depends on the question. Suppose the question is asking you regarding monetary policy situation, so you can say that repo rate is this, monetary transmission is happening, external benchmark rate based loans are increasing. You can substantiate your answers directly from this report. So it will depend on the nature of the question being asked. Okay, directly you can write these data because this is RBI's report, and I would say most authentic data which you can have for your answers is your RBI data. Clear? All right. Okay then, thank you so much. Have a great day. I'll see you in the next session. Thank you.